Hello, I'm Peter Towers. Welcome to Accountant's Minute. Predictive accounting identifies when fundraising required. That's the theme of our webinar presentation on Friday, 26th of June at 12 noon AEST. Because we're at the time of the year when budgets and cash flow forecasts and setting next year's strategies should be high in the priorities for consideration by your clients and obviously by you. First of all, of course, for your own firm, but then secondly as to how you are going to guide and assist your clients through this very difficult period of time that we have at present. So I would like to invite you to join with us with Paul Barnaby, a predictive accounting expert and the Australasian representative for Plan Guru, who's going to give you an overview of the necessity for accountants to be closely involved in the whole process that your clients should be going through. And that commences with the business plan. But the business plan is only one document out of a total of 4. We then enter the 3-phase financial forecasts. The budget is the monetary interpretation of what's said in the business plan. What's the vision, the aims, the strategies for the business? Let's now put it into a financial context. That's the budget. The cash flow forecast is how you take the budget and manipulate it with various normally external matters, debtors' days outstanding, creditors' payment terms, capital expenditure, the bank's decision on overdraft or the bank loans that the business has been able to negotiate, capital expenditure that the board of directors and leadership team have approved and your client wishes to implement. What's all that mean when it's put together into the cash flow forecast and then into the predicted balance sheet, just to make sure it all balances? Because after all, we are accountants. Everything's got a balance at the end of the day, and that's very, very important. I've seen some major blunders over the years where people haven't taken that on board as carefully as what they should have. But when you finish the cash flow forecast, it's going to highlight what the funding requirement for the business is. What is the shortfall and how is that going to be filled? And in 2020-21 terms, I don't think there's going to be a lot of opportunities, because unless you have arranged funding before 30 September 2020 for your clients, I don't think they're going to be able to secure funding from banks. They might be able to secure some loan funds from other lenders, but not from banks. And perhaps they should then be really thinking about either trying to raise capital under Section 708 of the Corporations Act or as crowdsource funding equity raising. Or through some of the other financiers, which really come back to Section 708 capital raising. Everything other than an initial public offer for listing on the stock exchange. Our other keynote speaker on Friday is going to be Arthur Ackers, the operational manager of Equitize. Equitize is an Australian and New Zealand crowdsource funding intermediary. And Arthur's going to take you through the process that has to be implemented if your clients wish to raise crowdsource funding equity raising. And it's an interesting journey, which starts with the initial review, an overview of your client's pitch deck, which is really putting into a graphic presentation what their business plan, budget, cash flow forecast, predicted balance sheets say. Where do they want to go? How are they going to get there? Who's their team? What do they need? What skills don't they have? And then the intermediary undertakes due diligence. They check the legal side of the information that's been submitted in accordance with ASIC's records. But they also look at the validity of some of the statements made in the crowdsourced funding offer document, things like contracts and agreements and client lists, if they're supplied, etc. And then they'll want to go to the crowd to get an expression of interest. This is where there's an initial listing, but not for money, just to find out how many might be interested in investing in your client's company and what their level of interest might be. Are they interested in investing $200 or $2,000 or maybe $10,000, the upper limit for a retail investor? More and more companies over the next 2 to 3 years, but in particular in 2020-21, are going to be looking very closely at the capital raising opportunities they have, because the market is going to be very limited for them anywhere else. Therefore, you, as a progressive accountant, advising your clients on a range of business matters, in addition to taxation, need to be across this whole question of capital raising, and in particular, Section 708 and crowdsourced funding equity raising. Therefore, I look forward to you joining us for this free webinar on Friday, the 26th of June at 12 noon AEST. Please register as soon as possible because numbers are limited. And this is going to be a very popular presentation. Paul Barnaby talking about the predictive financial forecasts that are very important to base your decision on what funding you may or may not require in your client's business. And then Arthur Acker's talking about the whole process of working with you as your accountant, but also with the crowdsourced funding intermediary to bring all this to reality, to raise the capital. And you'll have a very, very happy client. I look forward to talking to you this Friday, 26th of June, 12 noon AEST. See you then. Bye-bye.